Welcome to the debate. Imagine driving an 18-wheeler down the highway at, I don't know, 70 miles an hour. But your windshield is completely blacked out,
Sounds incredibly safe.
right? You are steering this massive, complex machine entirely by staring intently into the rearview mirror. You literally only know where you are based on where you have already been.
I mean, it is a terrifying way to operate anything. You would be reacting to hazards long after you've, already collided with them. If you were driving like that, your first instinct would be to hit the brakes immediately.
Precisely. Yet, as the text we are dissecting today points out, which is the future of tax compliance is real-time, this is exactly how global commerce has operated for decades.
Oh, absolutely.
Accounting teams, they wait until the end of the month or the quarter to gather up all their historical data, fill out declarations, and just report on the past.
Yeah, the classic, predictable, backward-looking rhythm of the business cycle.
Exactly. But today, governments worldwide are basically shattering that rearview mirror. They are shifting away from those old declaration-based models to, well, real-time digital oversight of economic activity. It's often referred to as continuous transaction controls, or CTC.
Right.
And I represent the view that this structural shift is a necessary, empowering modernization. By digitizing compliance through centralized infrastructure, we finally solve the multi-billion-euro VAT gap. But honestly, more importantly, this pressure forces businesses to clean up their messy data, providing the C-suite with real-time operational visibility that fundamentally optimizes the whole supply chain.
See, I come at it from a completely different way. While closing the VAT gap is, without a doubt, a legitimate governmental goal, transforming tax reporting into a mission-critical IT function introduces an unsustainable operational fragility.
Fragility?
Yes, fragility. Forcing complex global businesses to achieve absolute perfection, what this framework actually demands as 100% accuracy and zero human touch, it creates a system where minor technical errors or just a simple API failure can instantaneously halt legitimate commerce.
Okay, well, let's ground this in why governments are forcing this architectural upgrade in the first place. The retrospective audit model is dead because it fundamentally cannot police modern commerce. Consider how the VAT gap actually happens. In a traditional system, a company issues an invoice, they collect the tax, and maybe 30 days later, they are supposed to remit that tax to the government. But what actually happens?
The classic missing trader fraud. They collect the tax and vanish before the end of the month.
Exactly. By the time the tax authority processes the PDF or even the paper filing and realizes the data doesn't match the buyer's deductions, the fraudulent company is a total ghost. We are talking about billions of euros bleeding out of the system annually.
Right, it's a massive number.
So to solve a systemic problem like that, you need a structural, real-time mechanism. Tax authorities no longer want your data weeks later. They want to see it in their systems the very millisecond an invoice is generated. They are essentially becoming a silent partner in the transaction.
Silent partner is doing a lot of heavy lifting there.
I mean, maybe, but look at the empowerment it brings. For CFOs who might be dealing with this, real-time data means real-time visibility into liabilities and receivables. The author of our source material rightly argues this permanently eliminates month-end surprises.
Sure.
It forces a level of data integrity that, honestly, businesses should have been aiming for all along.
Okay, the theoretical benefits to the CFO might look fantastic on a whiteboard, but we have to examine the actual mechanism being used to achieve this data velocity. I am not completely against closing the VAT gap. However, I'm not convinced by that line of reasoning because you are entirely ignoring the cost of the enforcement mechanism.
What cost?
We are taking everyday, routine invoicing and turning it into a high-stakes digital workflow that severely jeopardizes business continuity.
Well, explain the jeopardy, because to me, it's just data transmission.
Oh, it is not just data transmission. Compliance is no longer a back-office accounting task handled after the fact. It is now a frontline enterprise technology architecture problem.
Right.
Consider the reality for a CIO operating under these mandates. Tax compliance has been elevated to a mission-critical IT function. If the API connecting your business to the government server goes down, your business stops. We are taking the very lifeblood of commerce, the exchange of invoices and payments, and routing it through a fragile digital choke point.
See, I think you're treating the government's digital infrastructure as an inherent liability rather than what it is, a standardization of the market. Let's look at the mechanics of continuous transaction controls globally.
Okay.
Look at the pioneers in Latin America. Regulators in Europe with Italy's SDI or Poland's KSEF. Or even the rapid adopters in the Middle East like Saudi Arabia's Zatska and the UAE's FTA. They have proven that real-time data flows are simply the new baseline for participating in the global economy.
I'm sorry, but I just don't buy that. Let me tell you why. You're using terms like data flows and transparency, which implies, simply letting the government look over your shoulder and see what is happening.
Because they are.
But let's look at the actual mechanics of a CTC environment. Invoices are no longer purely private documents exchanged between a buyer and a seller. Under the clearing model, they must be electronically validated, cleared, or reported, often before they can even be sent to the customer.
Yes, the government platform sits in the middle.
Exactly. That is not transparency. That is interception. The government is effectively acting as a gatekeeper to every individual sale.
Well,
Legally ask your customer for a single cent. A government algorithm must validate your file. If the algorithm flags an anomaly or if the API times out, you do not get the cryptographic token required to finalize your transaction.
which prevents the fraud we literally just talked about.
But at what collateral cost? Let's say a truck full of perishable goods hits the border. The customs agent scans the barcode. In the background, that scan pings a government API to check if the VAT invoice was pre-cleared. If a local server is undergoing maintenance or the network just has a hiccup, that API times out. The system returns a red light. The truck doesn't move. The goods spoil on the tarmac.
That's a bit dramatic.
It happens, all because of a microsecond digital handshake failure. You are tying the physical movement of goods to the uptime of a state-run server. That fundamentally changes a business transaction from a private agreement to a state-approved event.
That's an interesting point, though I would frame it differently. I don't see that digital handshake as a bottleneck at all. I see it as a modern digital immune system.
An immune system?
Yeah, think about it akin to a credit card authorization. When you swipe a Visa card at a terminal, there is a momentary check, a pre-clearance, if you will, to ensure the funds are there and the card isn't stolen.
Right.
Yes, it takes a fraction of a second, and yes, it requires connectivity, but nobody argues that credit card terminals jeopardize commerce. That momentary check prevents massive, systemic financial fraud. This is the exact same concept, just applied to B2B tax.
But that analogy falls apart completely when you look at the incentives.
How so?
A credit card authorization is a financial service provided by a commercial network to guarantee funds. Visa and MasterCard have a massive financial incentive to maintain 99.999% uptime.
Sure.
Tax preclearance is a regulatory hurdle. A government doesn't lose revenue if their API goes down for an hour. Your business does.
Well, you're right that the incentives are different, but look at the architecture. When Visa built their network, they created a unified bridge connecting millions of merchants to thousands of banks. In the current tax compliance world, businesses are trying to build thousands of individual point-to-point connections to different government servers. That is the actual madness. What this transition proposes, specifically the real-time compliance, or RTC framework, is effectively building that Visa-style network for global tax. It intercepts the transaction, yes, but it catches the errors before they enter the economic bloodstream.
But if the government is suddenly grading every single invoice in real time, the immediate victim is the system spitting out those invoices. Let's talk about the ERPs.
Let's do it.
If there are any CIOs listening to this right now who are running a heavily customized instance of, say, SAP across 30 countries, their blood pressure probably just spiked when you casually mentioned intercepting transactions.
Because their data architecture is a mess.
Because reality is a mess. The framework we are discussing demands that data flows from the source to the authority with 100% accuracy and zero human touch. Zero human touch.
Yes.
In a global business landscape defined by constantly changing regulations, hyper-localized technical standards, and bespoke supply chain contracts, expecting zero human touch is just a technological fantasy.
Why is it a fantasy? Automation is the standard in almost every other domain.
Because human intervention, manual reconciliations, fixing exceptions, isn't just a sign of bad data. It is how businesses handle edge cases. Let's look at the mechanics.
Okay.
Suppose a multinational company has a global master data code for a specific type of industrial lubricant. But the local tax authority in Spain classifies that exact same lubricant under a slightly different subcategory for environmental tax purposes.
Right.
Which requires a different decimal rounding rule on the invoice.
Which the system should flag.
Right. The government API flags it and rejects the invoice. In the old world, an accountant spots the rounding error at the end of the month, adjusts the ledger by 2 cents, and pays the tax. Business continues.
But
Under a zero human touch CTC mandate, the API rejects the invoice outright. The system traps the company in an endless compliance loop where no human is allowed to intervene. The goods can't ship over a 2-cent rounding mismatch between a global ERP and a local government algorithm.
I see why you think that, but let me give you a different perspective. If an invoice leaves an SAP system with an error that a tax authority can flag and reject in a millisecond, isn't the fundamental problem the company's internal data mapping, not the regulator's API?
You are blaming the business for not perfectly predicting the rigid, localized logic of 50 different governments.
I am blaming them for ignoring fragmentation because they had the luxury of fixing it in a spreadsheet 30 days later. Look, manual interventions and disconnected systems are no longer sustainable, and frankly, they shouldn't be.
Wow.
Forcing these complex ERP environments to achieve 100% accuracy is the exact catalyst global enterprises need right now. You say it's a burden to map that industrial lubricant perfectly. I argue it's a strategic pivot.
How does threatening to stop my supply chain amount to a strategic pivot?
Because here is the mechanism, the real aha moment of this entire transition. When you are forced to standardize your data so perfectly that a government algorithm accepts it instantly, you accidentally create the perfect internal data set. The data has to be pristine to pass the tax gatekeeper, right?
I mean, assuming you survive the implementation, yes.
Right. And once that data is pristine, it suddenly becomes available to the business itself. It becomes an absolute goldmine. Suddenly, your global procurement team has real-time visibility into exact spend across every subsidiary without waiting for end-of-month reconciliation. Your logistics team knows exactly what is clearing customs the very second the digital handshake happens. You haven't just satisfied the tax authority, you've created a real-time, flawless ledger for your own operational efficiency. That is the return on investment.
That is a compelling argument, but have you considered the inherent risk of the centralization required to build that flawless ledger? Because to solve the fragmentation problem, to handle the 50 different governments, the author strongly advocates for moving away from piecemeal local software solutions and building digital highways.
Yes, exactly. Centralized RTC infrastructure, a unified bridge between your global ERP and the various local tax authorities.
Exactly. And if we accept your premise that tax compliance is now a strictly regulated, real-time digital workflow with zero human touch, centralizing it merely concentrates the risk. It cements tax compliance as a single point of failure for the entire global operation.
It concentrates the capability to manage the risk. You build one highly secure, highly scalable highway instead of 100 dirt roads. When you centralize, you abstract the complexity away.
Abstract it away?
Yes. A change in a Polish tax law just becomes a technical parameter updated on the platform, totally invisible to your core SAP system.
Invisible until the highway collapses. Let's look at the mechanics of this single point of failure. You rely on a centralized RTC provider to bridge your ERP to dozens of global authorities. What happens when that central bridge experiences an outage or a cyber attack or, a routine security patch goes wrong?
Well, redundancies exist in any enterprise architecture.
But the blast radius here is totally unprecedented. If that central node goes down, you no longer just have an accounting problem in your Warsaw office. You have a total synchronized global operational shutdown.
Look,
You cannot issue an invoice in Italy. You cannot clear customs in Saudi Arabia. You cannot receive payment in Brazil. The digital highway you are praising becomes a digital parking lot.
But that exact same risk applies to literally any critical enterprise system you run today. If your primary cloud provider goes down, your business stops. If your global ERP itself goes offline, your factories halt.
Right, but
We have already accepted that modern commerce relies on mission-critical IT infrastructure. The paradigm shift we are discussing simply acknowledges that tax compliance has joined that top tier of critical systems.
But again, you are ignoring the third party in this architecture, the sovereign government. Let's go back to your cloud provider analogy. If AWS goes down, Amazon loses millions of dollars a minute. They have thousands of engineers working frantically to restore service because you are their commercial customer. Their survival depends on your uptime.
Sure.
If a government tax API goes down, you're just a taxpayer. The state hold absolute monopoly power and zero commercial accountability for their downtime. If their servers crash, they don't refund your lost revenue.
Which is precisely why the wait-and-see strategy the author warns against is so dangerous. You cannot wait for governments to perfect their uptime before you modernize your own architecture. Companies that view real-time digital compliance as a modernization project move significantly faster than those who view it as just a mere regulatory chore.
Okay, but
Yes, the government dictates the mandate, but the business controls the architecture it uses to respond. By utilizing sophisticated centralized infrastructure, a company essentially builds a shock absorber.
a shock absorber?
Exactly. The RTC platform insulates the core ERP from the turbulence of localized API changes or temporary government server outages. The platform handles the queuing, the translation, and the retry logic when the government server comes back online.
Like, I understand the architectural theory. A shock absorber sounds great. But we cannot gloss over the reality that this entire modernization journey is forced by the threat of operational paralysis.
I wouldn't call it a threat.
The framework tries to reframe this as a visionary data strategy or a natural cloud journey. Let's be honest with the audience. At its core, this is a business continuity decision forced by state mandates at the barrel of a gun.
Well, I think we are arriving at a clear view of our different perspectives on this revolution. To summarize my position on the mechanics we've discussed, real-time compliance is an undeniable, permanent architectural upgrade for global commerce. Yes, the transition is highly demanding. Yes, it forces companies to abandon their comfortable, messy, after-the-fact spreadsheets and actually deal with their fragmented ERPs. But in doing so, it provides the structural mechanism to eliminate the shadow economy and the massive VAT gap. More importantly for the businesses themselves, the mandate forces data excellence. Perfect data, flowing in real time, transforms a backward-looking regulatory burden into a centralized real-time ledger that optimizes the entire supply chain.
And to summarize my perspective, while I acknowledge the digitization of tax is frankly inevitable, and we both agree that closing the VAT gap is necessary, we must remain highly critical of the operational mechanisms being deployed.
Fair enough.
Transforming a back-office reporting function into a pre-clearance gatekeeper fundamentally alters the nature of a transaction. Mandating zero human touch ignores the messy reality of global supply chains, and relying on centralized digital bridges turns tax compliance into a fragile, real-time kill switch. The risk of a cascading operational shutdown, whether from a global platform outage or just a local API timeout, is profound and severely underappreciated by regulators.
Well, despite our different lenses on the risk, we certainly converge on one critical point presented in our discussion today. The landscape has permanently shifted. The wait-and-see approach will literally halt your supply chain. Governments are no longer just drafting legislation. They are deploying software. They are effectively behaving like global tech companies now.
We absolutely agree on that. The timeline for your IT roadmap is no longer dictated solely by the business's readiness, but by the regulator's API go-live date. The integration challenge is massive, and ignoring it is simply not an option.
It requires a delicate balance. On one side, we have the global drive for absolute regulatory transparency and the elimination of systemic fraud. On the other side, we have the absolute necessity of resilient business continuity in a complex, technologically fragmented world. It is a dual lens through which every CIO and CFO must now view their enterprise architecture.
It forces a hard look at the systems running our most basic functions. I mean, can your ERP actually generate a flawless data payload without a human intervening to fix a local anomaly first? That is the real, immediate test this revolution brings to your doorstep.
It is the ultimate stress test for corporate data, which brings us back to where we started. The days of steering the global economy by staring into the rearview mirror are over. The windshield has been cleared, the APIs are live, and the speed of business is only going to increase. The only question remaining is whether your internal infrastructure is robust enough for the road ahead.
Indeed.
Thank you for joining us for this discourse. We leave you to examine your own technological landscape and decide, are you still looking backward? Or are you ready for real time?